Welcome back, everyone. On behalf of Hightower Wealth Advisors St. Louis, we are happy to be part of this year's Dealmakers Conference. It doesn't seem that long ago that we were all here together in person. In fact, that was last February. But now we're here together having pivoted to this virtual conference, and deal making is still alive and well. At Hightower, we are seeing M&A activity as strong can be. There's a lot of cash available, and multiples are good. We think the strength of the public markets have an influence on this environment as well. As part of our role in the deal-making community, we collaborate with other professionals, and we work directly with owners and shareholders creating plans and investing proceeds. Ideally, we work with clients well in advance of the sale, as the planning process can have even more impact. At Hightower Wealth Advisors St. Louis, with our varied skills, resources, and experience, our ensemble of wealth advisors help you to make a plan, make an investment, and make a difference. And so it is with that in mind that we're elated to be part of Midday Dealmakers Awards. To kick things off, we have an amazing roundtable discussion with the first two of this year's award honorees. Tom Hillman, founder and CEO of Lewis & Clark Ventures, this year's Master Dealmaker, and Jim Everlin, founder and CEO of Top Ops, this year's award winner for Best Exit. Let me tell you a little about each. Tom Hillman is a serial entrepreneur and investor, having owned more than 60 businesses in a wide variety of industries, 16 of which have experienced successful exits. Notably, Tom was an early investor in Answers and remained on the board of the company through its nearly $1 billion exit. In addition to being a founding shareholder and board member of Hoovers, Inc., Tom serves on the Barnes Jewish Hospital Board of Directors and the Washington University Board of Trustees. He is board president of the St. Louis-based Center of Creative Arts and chairman of the Young Presidents Organization in St. Louis. Congratulations, Tom, on being this year's Master Dealmaker. Jim Everlin lays claim to having co-founded and grown the region's most recent unicorn company, Gainsight, which has a $1.1 billion exit this past December. Jim has founded three separate companies, Gainsight, Host Analytics, and his most recent venture, Top Ops. He is a serial entrepreneur. He is the recipient of the 2015 Missouri Governor's Award for Entrepreneur of the Year, and he is the chair and council member of Arch Grants. Jim, congratulations for being this year's Best Exit Award. And sitting down with Jim and Tom is Dustin Klein. Dustin is Chief Content Officer of Smart Business. Dustin is a best-selling author and national award-winning journalist. During his 3-decade career, he has interviewed thousands of entrepreneurs, CEOs, military, civic, and sports leaders. Dustin, Tom, Jim, the virtual stage is yours.
Ladies and gentlemen, I'm here with Tom Hillman and Jim Everlin. Gentlemen, congratulations and thanks for joining us here at the Dealmakers Conference.
Delighted to be here. Thank you.
Great to be here. Thank you.
So gentlemen, you've both built long careers of successful entrepreneurship and investing. Beyond the bios, which everybody can read and knows and has seen, could each of you share a little bit about your respective philosophies for deal making? And Tom, I'll start with you.
Sure. First, let me say it's a pleasure to be here with Jim. And when you look at entrepreneurs and deal making, Jim is the quintessential person because he's had multiple businesses, successful exits. And what I'm really saying by all of this, we're in the people business. And it's really about understanding relationships and having alignment with people, but knowing where they're coming from and underwriting them, that they're passionate about this business, that they are informed about this business, and they have the vision and are looking for the sponsorship where they're with the right partners.
Jim?
Yeah. Well, I'm really honored to share a screen with Tom Hillman and to be here with you, Dealmaker folks. This is great. And so, if you'd say like if you're asking about like what are some things that that are important, to me. I've started up a couple of different companies, and the first one I would say it's pretty obvious, but you got to really live it. It's never giving up, because like you always hear these stats of like all these failures of startups. I've heard 80, 90, whatever. I've heard all kinds. But it's the entrepreneur giving up. And that's not a bad thing either. Sometimes it makes sense. It's like, this isn't for me. I'm going to go back. I had a great job. I was making more money elsewhere and liked what I was doing. This isn't, this really isn't their thing. So that's number one. And that's, that's been an important thing. And then the other is to always look for an unfair advantage. And so, I ran into ups and downs in all my companies, and but there's always a move, and there's things that I founded this company called Gainsight, Host Analytics, and Top Ops, and each have their own little stories where like they could have failed just like the statistics out there. There was plenty of times they could, but there was always a move that we made that came out to a successful outcome. And so, and it's important to have that, because otherwise if you don't have an unfair advantage, you're not, definitely one of the most popular people in the region, if not further than that, is Tom Hillman. If you're going to impress a guy like that, you got to have this unfair advantage about your company. Otherwise, his LP isn't going to make any money off you. And so, so that's an important key thing to be always looking for.
Tom, along those lines, unfair advantage, how do you guys measure something like that?
Well, I think in any opportunity, you have to look at how people are positioning themselves in the marketplace. And as Jim says, how they differentiate. And so one of the advantages of having a fund is if someone says, I'm interested in software as a solution business in 3D printing, there may be 30 companies that we look at, and as a result, we will know who's doing what, how to compare that, but where they're putting a stake in the ground and staking their position of how they're going to differentiate and execute. So you have an advantage, and I'll call it more calculated risk, because you see more of the landscape and you can do all the underwriting you can do. But ultimately, it boils down to fundamentals of having a good business model and having the leadership that could execute on it.
It makes a lot of sense. Since we're here to really recognize both of you for what you've been able to do, I'll start with you, Jim. Most recently, we're recognizing you this year for Best Exit. And you've been part of the region's most recent unicorn deal with Gainsight. Tell us how that happened, especially out of St. Louis.
Yeah, it's so with Gainsight, it was a new market. It was a new market category. So all of my companies, I've got my sights set on a market category, but this one wasn't created yet. No one knew what customer success was back when I was first starting the company. And so, so that in itself was a nice advantage I had, but there was certainly the knowledge of this was all out in the Bay Area. So, you don't sell to Bay Area companies saying, hi, I'm Jim from St. Louis. I've got a great solution that's going to run your SaaS company out here. But, because they're going to be like, I think St. Louis, aren't you guys known? You're known for beer and the Cardinals. That's what But anyway, that I set up a presence out there. And I hired. This was kind of a bold move. You always make these moves that it either really works for you or you look like an idiot. But I hired the VP of Customer Success for Marketo, which was one of the top SaaS companies, especially at the time, and set up shop in the Bay Area. And it helped that I had an awesome CTO, this Sridhar Pedneni. But there were bumps in the road out there, but eventually I was able to raise money in the Bay Area because I had everything out there and I had a good presence there. And it's funny because I almost sold the company for $8 million And fortunately, they gave me a haircut on my final offer off that $8 million, and I said no, but I was going to say yes at the time for $8 million, and thank goodness that they came back with a lower offer. But and then we again, it helped with Gainsight, where Roger Lee at Battery Ventures, he was a mastermind that was involved there. Cultivation and Brian Matthews were good people too that came in and helped out there, and we brought in Nick Maida, the CEO, and with Nick and all this team of great investors, especially as we moved on, brand investors, we were able to outraise the competition, and they recognized the value of having a huge footprint here in St. Louis. So St. Louis's office is as big as any of them.
That's great. Been such a great success story for the region of what you've been able to do. Tom, let me shift over to you. We're recognizing you as this year's Master Dealmaker, and you were an early investor in Answers.com and the team over there, another unicorn deal. Can you share a little background on that story and some of its history?
Yeah, I sure can. I always say that a lucky break is when opportunity meets preparation, and at the same time, the harder I work, the luckier I am. And so that being said, I was a guest lecturer at Washington University in an entrepreneurial studies class with Barton Hamilton. And when I was in that class, I oftentimes tell the students, if anyone wants to reach out to me, touch base, have any questions, happy to help anyone. And frankly, people line up and take my card or they get my address, but very few follow through. David Karandash and Chris Sims followed through with me. And what I really want to tell you is I spent a lot of time with futurists, and there was a gentleman by the name of Wolfgang Grelke, and he had been spending a fair amount of time with me and talked about the internet and search being a little bit early in terms of its development and the opportunities. So I knew that there was really something behind their business plan. And Chris and David came to me and they had this vision and they had a business plan and they were passionate about it. And I believed in them. And so it was a time when I knew they were early on to something that I felt would have real legs and be something of substance. And so it turned out to be an incredibly successful partnership. And I was the first investor and only backer when we started the business in 2007. We ended up going through different iterations of doing some strategic acquisitions, bringing in some private equity sponsors, and ultimately having a substantial disposition to a large private equity group. But really, what I found in them is this mentor-mentee relationship where I've had more exposure and relationships that I could network for to bring in talent, to help with representatives, to increase and expand our board and representation. And we were really leveraging each other. But what was extraordinary is that Chris and David were like sponges. And they would be with any thought leader and they would absorb that. And then they would translate that and transport the business based on how much they were learning. And the irony of all these things is you start off as a mentor, and as you evolve down the road, you actually become the mentee. And so it was really a great relationship, great partnership with a good, successful outcome.
Do you think having that right management team and partners like yourself is what helped make it a great company with great returns for shareholders?
I absolutely do. And what's important about it is the alignment side, because what I really say is you need two people in the rowboat rowing in the same direction. And so many times you have different sponsors and partners, and there's a mismatch in terms of what people think they could do, and to really listen and have the empathy and to help try to do the critical thinking, problem solving alongside one another, you realize you're better together. So I think it absolutely impacted everything for its final result.
There's a saying I hear from a lot of investors, portfolio company managers, private equity, family offices, that a lot of times, when all things are equal, when you've got the right IP, right company, right clients, you're betting on the jockey. Somebody like you, Jim, betting on that jockey who you think can take the company through whatever the ups and downs are, work with you along the way. I'm interested, starting with you, Tom, what traits do you look for in strong investable management teams?
Well, I think people ultimately are measured by their leadership abilities. And part of that is they have to have really good EQ and be able to attract and inspire. And what I say is the best leaders can build a great C-suite for intensive purposes of calling their leadership team, but recognize how they could set people up for success. And part of this is to put people in areas where they are their best selves, and sometimes they don't even know what that is, but leaders recognize their special gifts. So I always say from an HR side, hire the right person at the right time, get them in the right seat in the bus, and then do everything you can to set them up for success. And it's really important to get that dynamic right, because the ultimate leader is going to be measured by the effectiveness of the team and their ability to understand strategy and execute on that.
Jim, that sounds like a perfect segue to you from the operator perspective. What do you look for when you're putting together the management teams for each of these companies you built?
I would say, like, the first thing I think of is I like an executive team that's on their way up. More so than done it before. Don't get me wrong. I like done it before, but I just know that the same recipe doesn't work all the time. Experience is a good thing, but I like to get someone with experience in that particular area, especially sales is really important. Product, marketing is big. Obviously, engineering. But I like someone that's maybe a stage or two ahead of where I'm at as far as the growth stage of the company. And, that way I feel like you get someone that's hungrier and, willing to learn. I heard a couple of years ago, I think it was some VC that said that he likes his executives to be learn-it-alls instead of know-it-alls, and definitely that's the case. I've done 3 companies now, and the recipe was never the same. And experience helped, but it was definitely not. And that was some of my mistakes was trying to apply the same recipes as the previous company.
Tom, Lewis and Clark's had as its differentiator that you guys have an operator's mentality. That's very well known, and rather than an invest and sell mentality. How does that really become the differentiator from other PE firms, and why does it stand out that way?
Well, I think the most important thing is that you could have real empathy for your leaders. And I think life is short and people have the luxury of being able to pick partners. And it's one thing to have capital. It's another to have smart capital and people that will collaborate with you and leverage their skills. And as an operator first mentality versus an investor first mentality, you're really relating and empathizing with the CEO or the management team, and you're understanding their challenges. And more importantly, the chances are you've been through enough different businesses, there aren't that many challenges that you haven't been faced with. And so when you are problem solving and you often have a lot of recommendations of a best strategy, not just to manage through something, but to lead your way out of it, then you create a trust and a bond and a working relationship that creates more power of working together.
Jim, when you were raising capital for these different companies at different stages along the way, how did you pick the different partners that you were going to align with, as Tom mentioned, to have different kinds of capital that brought more than just a check to the table?
Yeah, that's alignment is an important thing. Definitely someone that is, works well with the stage that you're in of a company, like from early stage to as you get into later stages. Obviously, VC is somebody that I've worked with a lot early on. And then as to more recently, I've been working with private equity. And I would say that, if you look at like the outcomes, for example, of, my three companies, Host Analytics, Gainsight, Top Ops, Host Analytics, and the outcome was with a private equity firm, great private equity firm called Vector. And they're very much an operational type firm. They filled some of the roles. So it was great for Host Analytics because Host, again, did very well in its market category. It officially, I don't know if they would like me saying this, but it's like it came in third place. So far, the race isn't over. In fact, it's a new race, a whole new game now that Vector owns them. But it was like they were perfect for Host because again, they Host needed some gaps to be filled, and they needed someone like them to come in and help them identify the right market to focus on, because they were kind of doing a broader approach. And anyway, still great leadership, and they. I love everybody at Host Analytics that I worked with and that carried on after me. But Vector was a great match for them. Where Gainsight, they ended up having Vista Equity Partners as their private equity firm that acquired them. And also, I've dealt with them more recently at Top Ops because I just recently sold Top Ops to Exactly, and I dealt quite a bit with Vista Equity Partners there. And so they're more of that. They're still into the rapid growth, unicorn style, go big or go home. They have more of that than say, in my opinion, than say Vector. Vector is more of like smart investments. Everybody's in smart investments, but I just mean like they're more focused on that, where Vista's more focused on having the leader. And so I think that the matches were great for all of these companies based on that, because Host Analytics was right there in need of someone like Vector, and the match between Gainsight and in Top Ops in a Vista company of Exactly was also a good match.
No, it makes sense. I mean, every need for the company, you said, is completely different, just like the management teams. Tom, actually, I'm going to pose this to both of you, but start with you, Tom. When you make as many deals as you guys have made along all these years, and all different kinds, I am sure there are some best lessons that you've learned along the way that you wish you had known at the other transactions early on. If you were looking back, what are some of the things you do today that you think, oh my God, I wish I had done some of those things 10 years ago, 15 years ago, 20 years ago? Tom?
Yeah, and I'll start. And before I do that, let me just say, Jim, we sold a company to Vista. And what I want to share with you is, oftentimes you come in and you have your SOPs, right? And you work with management. Well, it was so ingrained in Vista. They bought a local company that we acquired, grew it substantially, and then exited and did quite well. But they have what they call VSOPs, which is Vista Standard Operating Practices.
Yeah.
And they're 9 modules. And they go in on a deep dive, and they are about execution mode. And so there was a real value add. But that actually goes back to your original question, because a lot of this is underwriting, okay? And understanding the people. And what I have always said that I've learned later in life is understand the difference between sizzle and steak, okay? And what I'll say is all fluff and no substance, you don't have a business. And all substance and no fluff, you're not going to build the brand equity and get the enterprise value that you're deserving of. And what I would say is that we have heard people who are great storytellers, and I think that's very important for entrepreneurs to really know how to message and tell their story. But there's got to be something underneath all of that. And some of the mistakes I've made in the past is I've kind of fallen hook, line, and sinker of. And one of the other things I say about this is a deal never sounds as good as the first time you've heard it. And so as a result, if you do your diligence and you match that information out of the data and see the substance behind it, you want a great leader, a great storyteller, but it has to be a lot more than that.
That makes a lot of sense. And I see you shaking your head, nodding in agreement there, Jim. What do you wish you had known with the first startup you had versus what you had with your third?
Well, it's funny how, and that's why Tom knows how to pick deals. From what he was just saying there about, the all sizzle and no steak, and but then the other side of no fluff, And so what I was told with Host Analytics was I was that guy that, didn't establish the brand as well. I mean, we had we were first to market as a SaaS. We were the cloud-based Hyperion product, if anybody remembers Hyperion, but we were the cloud version of that. And that was such an advantage. I always talk about the unfair advantage. That was our unfair advantage, is that we didn't have to bring in servers. We didn't have to parachute in a bunch of consultants to prepare a bunch of stuff. You could just, virtually plug in to our system and then get to work. So I would say the mistakes I made early, maybe that's why Host Analytics only came in third place, was that I didn't put as much focus on the sales and marketing as I did on the customer, where I would say with Top Ops, I did the opposite of that. Even though I caught it in time, fortunately, if you can get through two companies, you can catch it in time. At least I did that. But I put in too much money earlier because I was thinking about Host Analytics, where I wanted to, I'm thinking, oh my gosh, this is a land grab to get to the AI for forecasting. And I had a competitor I had to keep up with. And I just couldn't, they outraised me. And so I didn't spend as much time with the customer in getting to what's called product market fit. Tom's heard that a long time. I've heard that a long time. Maybe some of the others haven't heard that much, but that really matters, that you make sure that your customers, who your customer is, why they're buying it, and why, and then how they adopt and get real value quickly. Because there's a time limit to all of this. And that's what I should have spent more time on early on at Top Ops. Eventually I just made it. I was able to, turn off the water spigot enough on the where we had a burn that I was able to turn it around, I guess you could say. But I don't think it was turn around. I think it was just kind of like I head in the right direction. And it ended up with a good outcome in time. But unfortunately, I didn't have anyone that really went way ahead of me, and it wasn't the network effects that some of these vendors get. So and the market's really just, it's in process right now. So again, I think the two important things are, product market fit and when to hit the gas. And I think those are two things that I if I could time those better over all three companies, I think it would have worked out better for at least two of them. And fortunately, I had I got really lucky with Gainsight.
Tom, you said something a little while ago that really struck me, that sometimes a deal it's the best look the first time you see it. That kind of reminds me of talking to people who I've asked, what was the best deal you made? And it was always the answer that impressed me most was when it was the deal that I walked away from. And I'm interested in both of you guys, as we're coming close on time, to think about something that was maybe an example of a dead deal that either you brought back to life, or some advice for others on how to approach those kind of challenges when they face them. And I'll start with you, Tom.
Yeah, let me just say that in business situations, whether you're looking at a deal, whether you are working through some challenges at a company, it's all about taking stock of where things are. And I'll just give you one example, and that is that we had a CEO of our company who was invaluable, and he was offered an enormous opportunity to go and run a company that was 40 times larger with more than twice the compensation. And I know we would have lost that company had he left, because we were in shaky territory. And part of leadership is being able to make changes and being able to make decisions, but really having people who could wrestle to the ground some of your challenges. And the person had given notice to someone else, and I felt that I had to step in. So I went to him at his home, and I basically said, I've never done this before, but let's put on a paper what we need to do to keep you, and what's it going to take? And he said, well, Tom, I've already given notice, and I've told these people that I would come. And I said, well, we're not done with our job. And you and I have this relationship. We have this vision. And what's it going to take? It's got to be something. And we were able to work it out. And he now is on top of the world with us. We're having the best results we've ever had. And he looks me in the eye and says it was absolutely the right decision for my wife and I to stay and do this. And I love my work. So thank you for doing that. So sometimes there's situations where if you don't step in, you're going to lose it. And I also say that it is true. Some deals, and particularly in today's market, these false expectations of value, where it's all sizzle and people wanting irrational exuberance in the market, sometimes you have to walk away from those things. And there may be another fool's gold that will come in and pay you a lot more. And sometimes you wish you had done those things. But I will tell you honestly, we brought in more equity at Answers along the way, and we would have made 3 times more money than we already made if we retained it longer without diluting. But I have zero regrets because it was the right decision at the right time. So I don't lament over some additional profits we could have made when you really are doing this collaboratively and you're smart as you navigate your way through all of it.
No, that's great. You know, you could have easily just let that gentleman leave, that executive leave, and that would have been the end of that deal. Jim, we're almost out of time. I want you to focus in on this. You mentioned the haircut coming back on the deal for almost $8 million on the company that ended up being the greatest thing you walked away from. Are there any other examples that you'd like to share with us that maybe were either second guesses or things that a deal that didn't work that you brought back to life and made happen later?
The only thing, when you asked that question, at first I was like, I can't think of really that was a good reminder. The Gainsight deal where I walked away from that, which was good. But as far as I keyed in on like bringing it back to life, and I can tell stories on all 3 companies, Host, Gainsight, Top Ops, where we were really headed into the abyss. And with Top Ops, it's the most recent story where I had a competitor that outraised me by hundreds of millions of dollars in venture capital. So I kept Top Ops very efficient. And in fact, I'm the biggest financer of Top Ops. And so what I did is I ended up partnering. I went to a few partners that were likely good partners, and one really caught on. And all of a sudden now I had at least double the sales reps that they found my product actually easier to sell, or a great way to to break it, because a lot of times when you get acquired, especially by the much larger software companies, your product disappears. In fact, I've loved it when some of my competition have been acquired by, some of the really big companies out there. But this company really did leverage Top Ops, and it still is. Exactly is now leveraging it and changing their messaging. But what we did to get acquired by them is that we proved it was a lot of work. You can't just say, oh, well, I'll just go get a partner. It's a lot of work, and it was a lot of effort. But we got them actually selling our product, got all the reps selling it, and it ended up in a great exit, a great outcome for us. So I would say like that's we were near.
Yeah.
We're in a bad spot there as compared to the competition, and this is what really turned us around.
No, that's a great story. And gentlemen, I could keep asking you questions for another half hour, but we are out of time. Jim, Tom, I want to thank you for sitting down with us here at the Dealmakers Conference. This was a great conversation, and I hope everybody out there really enjoyed it. A lot of the great lessons that you shared. So thank you.
Thank you for including us, and it's been great doing this with Jim. I have a lot of respect for him, and so thank you.
Yeah, anytime I can share a screen with Tom, I'm there. Thank you very much.
Thank you, gentlemen. That was a great conversation. Now let's meet Tom and Jim's fellow Dealmaker Awards honorees, who together comprise the class of 2021. And that starts with Kelly Eisenloffel, President of Larson Commercial Real Estate. Kelly, congratulations for your firm's most recent Larson Capital Real Estate Fund 1 and your continued acquisition of properties in and around the St. Louis region. Larson Commercial Real Estate, headquartered in St. Louis, is an alternative investment company focused on real estate. The firm's portfolio includes numerous properties and provides an opportunity for investors to diversify their portfolios through real estate-based investments. Among its current initiatives are the Larson Capital Real Estate Fund 1, the Oliver, and Larson Capital Opportunity Zone Fund 1. Congratulations, Kelly. Well, Kelly, congratulations to you and Larson Commercial Real Estate. It's nice to meet you, and I look forward to our discussion today.
Thank you. I'm glad to be here and glad to be accepting this on the behalf of the Larson team.
Kelly, you were named president in October, and then the next month opened the most recent fund, the Larson Capital Real Estate Fund 1. What's the goal of this most recent fund, and how should investors be thinking about real estate as an alternative investment vehicle?
So really our goals for LCREF 1 it's very similar to the goals of the remainder of our funds. We are offering our clients a way to invest in an asset class that's not strongly correlated to the stock market and providing stabilized cash flow on a tax-deductible basis. Real estate uses accelerated depreciation as a way to provide a negative tax implications on annualized distributions of the real estate's cash flow. So after acquisition, we engage cost segregation analysis that takes all those improvements on the site into account instead of just depreciating the land at its value and the building at its value. We really work to break down every improvement down to flooring and paint to get immediate depreciation working for the investment, which just creates a great model for investors and for our company alike.
Fantastic. Kelly, Larson also has an Opportunity Zone Fund. How will Opportunity Zones impact the regional economy, and what does it mean for real estate development?
So our region does have a large geographical area dedicated to Opportunity Zones. Developers here are able to redevelop in those areas and take advantage of several tax incentives and benefits. For a large group of our investors, it really is icing on the cake for them. It's a way for us to revitalize the areas that we're very passionate about and that need it so much. It's merely one part, however, of a whole transformation for our communities. I can't speak for other firms, but we're showing a larger percentage of equity being appointed to our Opportunity Zone funds versus our other funds. The impact of the Opportunity Zone development is just a start, as I mentioned, for our region. As a real estate firm, we'll certainly build it, but it will take so much more to turn the tide around as we continue to work closely with local business groups to help shift the state of the region.
And how has the response been raising capital at the tail end of the COVID pandemic?
I will say we did see a sharp decline from March to June in the amount of funds we were raising and bringing in. Towards the end of the year, funding was back on track and matched that same time in 2019. We're really continuing to make connections around the country and through our partners at Larson Financial. So while we saw a decline, overall raise for 2020 was matched back to 2019.
Okay. Kelly, what do you anticipate in the next 12 to 18 months looking like for both real estate and the region, and also for your firm's strategic growth plans?
So in 2021, Larson will be focused on our Larson Commercial Real Estate Fund 1 that we spoke about earlier. This fund will diversify into all asset classes, where our first 6 funds were specific to Class A stabilized office product. We have several projects in underwriting to hit this fund this year and hope to have it full and closed by year end. In addition, we are launching several non-real estate funds to fill out our alternative investment platform. We'll be looking at investments specific to medical advancements, financial service firms, and the oil and gas industry. So a very exciting year for us.
Well, that's exciting. Thank you, Kelly, and congratulations once again.
Thank you.
Congratulations, Jonathan Herrick, CEO of Benchmark Internet Group, for your company's recent capital raise. Benchmark Internet Group is the developer of sales and marketing platform designed to help businesses ignite relationships with customers. The company's email marketing software sends compelling emails, including forms and landing pages, and offers behavior-based follow-ups triggered by interactions, enabling clients to grow audiences, increase loyalty, and drive business. The company has been on a fast-paced growth curve, raising capital and making acquisitions. Its most recent activity was a $3 million debt financing capital raise in January of this year. Jonathan, Benchmark has been around for a while now, but it's only been in the last few years that you've really begun to grow through acquisitions. What spurred that?
Yeah, so it's an interesting story. Benchmark Email was founded back in 2004 by Kurt and Denise Keller. And actually, I was an early customer back in 2006, so I knew of Benchmark years ago. We had a tech company. We sold it to Vista Equity, and we started a new company back in 2012 called Hatchbuck here in St. Louis. I officially took over CEO in March of 2019. And we began talks, and what started with an acquisition talk of us acquiring Benchmark Email became a merger opportunity in September of 2019. So our two companies merged in September of 2019, and we haven't looked back since. We've made a number of acquisitions to help fuel growth, and we're also driving organic growth as well.
All right, fantastic. Jonathan, in January, you raised $3 million in debt financing from Texas Capital Bank. Why did you opt to go that direction when you were raising funds?
That's a great question. You know, there's always, as a founder or CEO, there's always options, whether it's equity, whether it's mezz debt. There's so many different opportunities given to SaaS companies. For us, it just made sense to do debt financing. We're highly profitable, so we have cash flow, and we're growing as a business, and there's no need for us to give away equity. I can't speak more highly of Rob McFarland over at Texas Capital Bank and the entire team. As part of fundraising from a CEO perspective, it's not when you need funds, it's constantly. You're always building relationships and networking with VCs, PE firms, and banks that understand the SaaS model. The main reason we went with Texas Capital Bank is they had a strong understanding of SaaS operations, and we look to them as a funding partner, not only now, but as we acquire more companies.
Okay. You've started deploying the money through the acquisition of Contacts Plus, also in January. How did that deal come about, and how does that fit into the suite of offerings you've been building?
That's a great question. So Context Plus was a tremendous acquisition for us. We started having conversations with them last summer. So deals take time; they just do. And we started building a relationship with them. And Full Contact was the parent company of Context Plus. We had already had a vendor relationship with them, so we knew of them; they knew of us, and so that made for a smoother transaction. We acquired them in January of this year, and Context Plus is a contact management app that syncs contacts across all your devices. And they serve a ton of industries, including wealth management, investment firms, real estate firms. And so there's natural synergy with the contact management of Contacts Plus and the CRM, the email marketing tools that we have at Benchmark.
Okay. And what's next on the growth horizon for your company?
Well, I would say more acquisitions. Right now, I'm letting the team rest a little bit. There's always work to do when you acquire companies. So we're in growth mode right now. We'll be looking at acquisitions towards Q4 of this year. Have some significant opportunities already in the deal pipeline. But for us right now, it's really focusing on our core customer, making sure we're delivering a great experience across all of our products, and unifying our company to have more clarity and more focus across all products in all regions.
Jonathan, when you look at what's hot in the industry right now, what do you see the trends going on?
Well, there's a lot of M&A activity since COVID, believe it or not, and so that's a trend. I think the biggest trend for SaaS companies right now is the shift from sales and marketing-led growth companies to product-led growth companies. There's an acronym called PLG, which is product-led growth, and really the concept is instead of investing a lot of time and resources on the front end on sales and marketing, really investing into the product and let the product drive your growth. And those companies are seeing a higher valuation than companies that deploy more of a traditional sales methodology. For example, if you look back 3 or 4 years ago, SaaS companies were really built on SQLs, MQLs, moving people through the sales pipeline. And now with product-led growth, it's all about driving a product that can allow users to get into your platform for free. And then once they're in, you have more product specialists than you do salespeople, where they're product experts and they're helping that free user get value out of your product and then eventually drive them into a paid subscription and a long-term customer. Companies are seeing lower acquisition costs with that model. They're seeing faster growth and ultimately higher valuations when they look at the market, the M&A market for SaaS companies.
Very good. Well, thank you, Jonathan. It's been a pleasure.
Absolutely. You have a great day.
You too. Congratulations, Peter Esparago, co-founder of FinLocker, for your company's recent capital raise. FinLocker, headquartered in St. Louis, is a fintech company which has developed a financial data and analytics platform that helps people achieve the dream of home ownership and financial well-being. Its platform offers access to critical borrower information via a trusted third party that can be used to streamline the lending processes for mortgages and other financial products, enabling lenders to reduce costs, time, and risks in the loan lifecycle while expediting the data collection, verification, and analytics processes. Last October, the company raised close to $20 million in Series A1 venture funding, and a deal led by Cultivation Capital, and including TransUnion, St. Louis Archangels, and C9 Capital. Congratulations. Peter, congratulations to you and FinLocker. It's nice to meet you, and I look forward to our discussion today.
Well, thank you so much. We at FinLocker is very honored to be recognized for the significant deal we did last year.
Peter, FinLocker's financial data and analytics platform is designed to help people achieve the dream of home ownership and financial well-being. How does it work?
FinLocker's a financial super app that helps people meet their financial goals and get mortgage ready. Imagine you're a first-time home buyer. You don't know how much of a mortgage you can get approved for. FinLocker provides you with 1, credit score, report, and monitoring. 2, Real-time aggregation of all your financial accounts and detailed transactions like checking, investments, credit cards, student loans, auto loans. 3, financial education related to home ownership, mortgage, credit, and more. 4, budgeting, goal setting, and spending analysis. 5, market-leading analytics that tells you mortgage readiness, like how much of a loan you can get approved for, that factors in your credit, debt to income, loan to value, down payment, and more. 6, real estate search to find your dream home. And when you're ready, 7, streamline mortgage application and approval.
That's fantastic. How did you develop the idea?
One of my co-founders, Tim Stern, who has very deep mortgage industry expertise, thought of accessing and analyzing data straight from the online financial accounts to automate the very manually intensive mortgage origination and underwriting processes.
And how was the company initially funded?
My co-founders, Tim Stern and Barry Sandwise, and myself provided the startup capital.
Okay. Last October, you raised close to $20 million in Series A1 venture funding in a deal led by Cultivation Capital. What did you learn from this round's raise that may have been different from early rounds?
Very good question. Cultivation Capital was great in leading the ground, but when TransUnion became a strategic investor / customer / partner, it was a tremendous catalyst. When word got out that we got a global, publicly traded strategic investor, the round became oversubscribed, and I had to turn down a lot of investors who wanted to get in. All investor money's green. Getting a key strategic investor / partner is a game changer.
How are you developing that cap raise and deploying that?
So we've been very, very busy in significantly growing our team to dramatically scale our business.
Okay. What opportunities do you see for moving forward to grow the company and expand its reach and its suite of offerings?
Thank you for that question. This is what's really exciting. We started FinLocker with a very deep focus on the mortgage industry. We're now getting pulled in by companies as a tool for employee financial wellness and by banks to utilize FinLocker, not just for mortgage, but for auto loans, student loans, consumer loans, credit cards, small business loans, and more.
Fantastic. Thank you, Peter, and congratulations again.
Thank you so much.
Our next honoree is No Inc., along with Managing Director and Founder Scott Leindecker. The company develops electronic poll book technologies intended for election authorities to meet the individual needs of municipalities, cities, counties, and states. No Inc. offers products that allow for seamless voter check-in and verification that is dramatically reducing wait times for voters and saving money for taxpayers, with efficiencies for state and local governments, making the voting experience easier for voters, more efficient for election workers, and more affordable for taxpayers. In February, the company acquired B-Pro, adding to its suite of offerings. Congratulations, Scott Leindecker. Scott, it's nice to meet you, and congratulations to you and No Inc.
Yeah, it's a pleasure to be here. I want to, thank you guys for the opportunity and the award. This is really great news.
Scott, how are you applying your experience as a former election director at the city of St. Louis to the company's growth strategy with its PollPad electronic poll book and ePulse election management application?
Well, I think they kind of go hand in hand with the technology. Obviously, the technology is related to elections, and in my past field, being an election director, that kind of has given me a leg up in understanding the processes and what's needed. But also, I think just, kind of being, somebody that's been in the trenches with former election officials gains me that trust and the notoriety with them for them to feel that they can trust me with being in their offices with them, helping them, move forward.
You've raised capital from Herman Companies and you recently acquired BPro. What does the acquisition and the capital infusion mean for your suite of services and your ability to continue expanding?
Well, it's really been, with Herman Capital, it's really more not necessarily the money, but the leadership and the guidance that Rick and his team give us. That's what we've been looking for. Capital has always been, something that we haven't needed in the past. We bootstrapped the company from day one and have been very successful. But really having somebody lead us into that next, area, of acquisitions and growth through acquisitions and things has been great. To have Rick and his team on board with us to help guide us. And BPro is that one of the first acquisitions that we made. They've been able to, help us, in other areas like voter registration, where we're wanting to move into that field. So it's been really a great partnership so far, and we're really excited about the future, with BPro.
Did you encounter any issues conducting due diligence during COVID?
Not really, because it's a small market, with in elections. So I knew them, kind of going in. This wasn't something that we were searching and finding. We knew each other from, just working with each other. So knowing the business and understanding their team was, we already knew them. So that was great. Really just diving into the financials and looking at that. Making sure we were checking all the boxes. That was Rick and his team to help us in leading that effort. But, we haven't visited them yet. We're getting ready to go visit them. I think next week. I just got my second shot. So I'm looking forward to actually getting up there and saying hello to everybody.
That's great. How is the integration going?
It's going really well. We've already integrated in a number of states already, like North Dakota. And we're looking to move forward in like Oregon and hopefully in Clark County, Nevada, and a handful of other jurisdictions that we've recently submitted RFPs together with. So it's been a really great partnership so far.
Streamlining elections is something that looks like the wave of the future. How are you positioning your company to be the company of choice, transforming the elections world?
Well, we've been on the forefront, I think, with PollPad and really bringing technology to the forefront of elections. Before, when you walked in, 10 years ago, you were, basically it was a pencil and a pad of paper, that you were signing. We've really streamlined the process with using technology and off-the-shelf products like iPads and things like that. We think that technology is really the way to go when you're wanting to get, results quick. As we saw this last presidential election, it drove on for, several weeks. And I think that was because of, technology was not adapted correctly, in a lot of jurisdictions due to COVID and a number of other things. So we've, just this past year, just with early voting and things like that, we've helped, over, I think it's about 1,400 jurisdictions nationwide, get through the November election. And we're looking forward to showcasing, our product to a lot more in the future.
So what's next for you and Know Inc?
I think we're looking at, some other acquisitions. So that's kind of one of the things that's on the forefront for us is try to, not only grow through what we've been doing through sales, but also through acquisitions, and continue to grow the market that way. We've really dominated, over the years. We feel like, the future looks really bright for us, and we're just happy to be kind of where we are right now, and we want to continue to push forward.
Well, that's great. Scott, it's been a pleasure meeting you, and congratulations once again to you and Know Inc.
Yeah, I really appreciate it. Thanks for this honor. We really appreciate, the recognition.